All right, so we will be doing a little bit of a dive into analyzing a deal. And with that, I have actually not fully analyzed this deal. I'll actually have to clear out a lot of this data. So bear with me as we kind of go through this. But we are looking at a duplex here in the Southwest Portland area. Note that it is in Washington County. Looks like it is taxes around 5,426. So with that, I am putting this into the deal calculator, and this is something that I usually will provide to my clients when I start working with them, just so that way it's something that they can better understand this. And again, the whole purpose of me doing this is so that way you can get a better understanding of basically how to analyze a deal. So just adding in a few details here, one being at the square footage, so the number of units, and then the taxes. I'll throw in the address in there as well. And then we've got the list price of $839. It's been on the market for about 18 days, remodeled in 1976. So I'm kind of considering. It does look like it has been redone. It has a garage space, which is nice. Laminate vinyl plank throughout. Yeah, this has actually been done relatively well. So I don't think there'd be a ton that would need to be happening on this. And then some other notes that I noticed was that looks like both are rented out, so those are kind of closer to what the actual rates are, along with there being a newer. Looks like some French drains and some pump, along with a new deck and fence yard. So those are actually pretty big things. When it comes to analyzing these deals, I typically will go with the building type of being close to the apartment slash condo, since that's going to be closer to what it actually will be. You can still do the apartment, or sorry, the house duplex, but that does tend to become a little bit more problematic. So this is definitely interesting in terms of the fenced area. Looks like each area has their own little place. And then with that, let's throw this back into the deal. 9. You probably wouldn't have to put in any repairs at this point. That's just where it's at. We'll say it's a 5% down payment. And then when it comes to the units, one is a 3.1.5, and then the other one is a 2.1. And then I'm usually finding that right here. So 3.1.5 is around 2,325. Just put in what it actually is right now, and then the other one was around 280 or 2080. All right. So with that, I have added a little bit on terms of the interest rate, just giving about a quarter point. And then let's say that if you were to house hack this, you are probably going to have relative. If we just zeroed out all this, you can also see the PITI along with what the monthly income is, and there's still a fairly hefty difference between the two. So I'm wondering at what point would this work? And let's say 800. I think it'd probably have to get like if we were just doing it purely off of price, we'd probably have to get significantly lower in order for us to even attempt to break even. Now, the part about this that it's a little bit trickier to do is, especially now with interest rates as high as they are, is if we do get to a point where it can refinance. So let's say that even if we get to like the 800 mark, let's say that rates are 4%. I'll say 5% on the. It makes sense. These numbers make a lot more sense. At least they get closer to what it needs to be. I'm actually also going to, in this case, I'll keep the PMI and I'll remove the HOAs. So I mean, it does cash flow a little bit later. So it does take until about year 5. We're kind of zeroing all these out. And I do think that this is probably just a little bit on the high end. But if we're looking at the values here, and just put in the 3-bedroom. So what I usually go to is rentmeter.com. You go to rentmeter.com. You can then add in these addresses. At this point, I've maxed out what it is. Then you can add the building type. I typically will go with the apartment condo and then the 3-bedroom, 2-bath. So when I did the calculate, or when I ran this report earlier, it looks like the max or median would probably be around 240, or sorry, 2,400, and then the higher end would be 2,636. So you could potentially get this a little bit higher, but it depends on whether or not there's utilities or things of that nature in there. So overall, I don't think that this is a fantastic deal. I'm wondering if you could potentially get this at the remove the PMI, essentially prepay the PMI. That might be something that would then make that work. But again, this is still pretty far off in terms of being able to cash flow quickly. But if you start looking at this from a long-term perspective, this is really where the power of real estate, in my opinion, is. Of like, if you buy this asset maybe 15 years down the line, it's still making you about 48 grand or 50 grand a year, and then it's closer to 1.6 million, and then close to 200,000 when you get to the end of that 30-year time frame. So just something to kind of keep in mind. And actually, just to add in all the stuff again, I'd say probably lower maintenance right now. Looking long term, let's go a little bit higher on all these just to get a better accurate picture. So still 560 overall in terms of the cash flow. So with all that in mind, I don't think this is a fantastic deal. I think that if this was maybe a little bit lower priced and then we also got it at a lower interest rate, probably work. But besides that, I don't think it's going to be something that would be really feasible at this point, or a great deal until you probably get to like maybe investing 20 to 25. Yeah. So let's even say 7 point, be on the optimistic side, say 7.64. Even at a 20% down payment, it still does not cash flow super well, but it does probably cash flow. Remove some of these and you're self-managing maintenance and things of that are probably lower. So usually I'm adjusting these. If I'm looking at the closer numbers, I'm adjusting them a little bit more or less conservatively, and then as I go further out here, I am using them a little bit more conservatively or increasing them. So in this case, it would be cash flowing probably closer to year 4. Yep, year 4. So again, you still have to be throwing down a hefty amount in order to make this cash flow sooner. And I'm not sure if the cash on cash return would really be worth it at that point. So with that, if you have any questions or you're wanting to dive into house hacking or get a better understanding of how that goes, feel free to reach out. I'll make sure to have my contact information down below. And thanks so much for watching.